That headline inflation number would be very concerning. There's no rate cuts in the foreseeable future based off that data. And if that data continues to trend how it is, the next move will be up. Well, I don't think the rates are going down anytime soon, my friend.
Neither do I. I actually had a bet going yesterday with someone in the office. We're betting coffees. It wasn't, wasn't gambling per se. But she said, I think it'll drop 0.10, 10 points. And I said,
0.1?
Yeah. I thought, well, anyway, I'll tell you who it is later.
Who was that? We need a second.
And I said, won't drop at all. It'll be, which we were obviously right. I feel like I won a coffee. I ended up donating that coffee to Adrian because I felt wrong making the bet afterwards because I feel like I had some
advantage.
You're
in the know.
I just feel like we could see it.
You got Michelle on speed dial. Hey, Michelle, what are we doing?
But I think everyone came to a conclusion. I think if you asked me 2.5 months ago, what will happen in November for the RBA meeting, I would have said with like 99% certainty that there was going to be a drop if you asked me 2.5 months ago. But as we got closer and inflation figures came out, I think especially in the last week, with 100% certainty, we could say it was going to stay the same.
Yeah, it's the shift in inflation figures.
Yeah.
I mean, that headline inflation number would be very concerning.
Yeah.
And it's reflective in the statement from Michelle. But look, it is very concerning, that inflation number. And I would be very concerned because they are going to head to a position where, to me, there's no rate cuts in the foreseeable future based off that data. And if that data continues to trend how it is, the next move will be up in terms of rates.
When you say the next move will be up, do you mean the next RBA meeting will be an up, or the next time they move, it'll be in a upwards
I'm saying if
direction?
that data continues in the way that it is, the inflation data specifically, I know there's a dual mandate for employment, but I think they focus, whether they say it publicly or not, but there's a focus on the inflation data. If that inflation data continues in the trajectory that it was, or that it is, then the next move will be interest rates going up. And that should be a major concern.
The question is when, because I can foresee 2026 being the year of no cuts at all, like no cuts and like no movement. I see 3.6. If you ask me today, how do I feel? I'd go, I wouldn't be surprised if we had 8 RBA meetings next year with no change. It would not surprise me at all. And I say that because there's a few things that I'm looking at closely, right? So the data's the data and you can't argue with the data, but you can start to predict what the data might do. And I believe like man on the street, which I think I am a man of the street and speaking to people on the ground.
Man of the people.
Man of the people. Thank you. There are 3 things that I'm looking at. One of them is sentiment, right? So, and what I mean by that is, I think if you are, again, going back to the start of this financial year, everyone, the banks, the economists, everyone that knows what they're talking about or is supposed to know what they're talking about was saying we're going to get two cuts this year and there'll be more next year. Everyone was saying that. So man on the street, man of the people, they start to price that into what they're doing every day.
And you think they make those property decisions are based on what they think rates are going to do?
Whether it's property, whether it's coffee, whether it's holidays, whether it's retail, they're making decisions.
Do you reckon it's that deep though? Do you reckon it goes beyond property? Like, do you I know you always talk about a bag of chips on this show. Do you think you make different decisions if you think rates are going to go down?
You do. If I think to myself, great, everyone's saying rates are going to drop twice, I'll buy the coffee, let's plan the holiday.
So you've already spent that money you think you're going to save.
It's like the guy that buys the lottery ticket and starts thinking, okay, I'm going to win $3 million. What do I spend this on? It's exactly the same. So everyone is thinking this way. So everyone's spending and inflation, what happens? Inflation goes up.
So let's dig into that because if everyone plans for the next 6 months, rates are going to drop another 2 times and they start spending more.
Yes.
They buy that washing machine or they go and spend extra on groceries, whatever they do.
That's what happened exactly.
And then that increases, by virtue, it increases inflation.
Yes, that's exactly what happened.
Which then means rate cuts don't happen if inflation gets out of control.
That's right. And so that's what happened here.
So it's a double-edged sword,
But this is what I'm talking about. This is man on the street. I'm not talking data.
So return the washing machine?
I'm predicting the next data, right? So what's going to happen now, right? So now, no cuts. And then there's people like you saying, hey, next movement's going to be up.
If the inflation data continues. Yeah.
But people don't hear that part. People don't hear if. They hear the guy with the nice haircut going, who knows what he's talking about, saying next movement is up. So stop spending, right? So they do stop spending. And what's going to be really interesting is the next couple of months. So we're about to go into what is typically retail period. We're going into, what is it? The
Christmas period,
Well, it's Friday. What is it? The
Black Friday.
Sorry.
Black Friday sales.
Black Friday sales. We're going into Christmas. It'll be very interesting to see what data comes out of that in January. So obviously sales are going to be higher from a retail perspective, but how much higher? Will we start to see headlines like, hey, we had the worst Christmas ever from a retail perspective? Will we start to see headlines about small businesses closing more and more often? I think that's what's going to happen because people are hearing, hey, maybe this interest rate cycle of decreases has ended, so I need to tighten the belt.
So you think little Johnny may not be getting that new bike?
Little Johnny may not be getting the new bike.
So, I mean, do you think that changes how people will be spending?
100%. It's meant to, so like I said, the same way they price in, there's going to be 3 interest rate cuts, they're now pricing in, hey, maybe there's not going to be any more. And hey, maybe the next one is going to be a rise, or maybe the next time there is movement, it will be a rise. So
that's consumer sentiment. What do you think it changes with property? Because I think if you think you're on the rate, if you think rates are on the way down, and the cycle of upward rates are over, that gives you more confidence to go out and purchase. Then we had the introduction of the 5% deposit scheme with government, which we all know has put fuel onto an already burning fire, a pretty savage fire when you're just chucking additional fuel on. If we look at those two scenarios together, and then you've got the people that think maybe they've missed the boat on the 5%, and then the interest rate sting, there's a sting on interest rates. Do you think that changes how people buy property? I would think that it would take a bit of the sting out of people rushing into the market. They might be a bit more cautious, which then brings interesting what happens on the property side of things.
It's funny because having a conversation with producer PJ yesterday before the rate announcement, I said, what do you think? He goes, I hope. He didn't say I think. He said, I hope that they don't drop rates, because I'm looking for a property, and if they drop rates, prices go up, right?
Just creates more hype.
Yep. We're seeing, so the 5% deposit scheme for first home buyers is an interesting one. I think a lot of first movers got the advantage, but prices are going up from there. Every agent you speak to, everyone in property that you speak to, they say, yeah, interest rate cut is good because it gives people more confidence. But we've seen a couple of cuts and the confidence hasn't come back.
Yeah, agreed.
Right? It hasn't come back. And so that's really interesting. You still see in property record sale here, record sale there. So sales are still happening. People are still transacting. But I think from a top view perspective, there's probably less transactions happening. And I would say that what we do know is it's taking buyers on average 22 months to make a decision. If you read into the RBA data, it's taking them 22 months on average. That is longer than ever before, and that's only going to get longer. People are sitting on the fence. What are rates doing? What's this 5% thing? People are sitting on the fence, and that uncertainty that starts from the inflation discussion does bleed into their property decisions as well, in my opinion. Tell me if you disagree.
I definitely do agree. It comes to the confidence. We always talk about property being a confidence game, and it definitely affects. I just actually want to read one of the statements here from the statement with the RBA rate decision. So it talks about inflation in the Australian economy has picked up recently. But this particular statement was probably the one where I think everyone needs to watch. And this is why I'm saying if inflation continues on the trajectory that it's going, the next move will be up. It's because of this statement right here. So headline inflation increased to 3.2% in year-ended terms in the September quarter, which was significantly stronger than expected at the time of the August statement. The increase was driven by higher electricity prices following the partial unwinding of household rebates, which should never have been there in the first place. Price increases in more volatile items like fuel and higher underlying inflation. Underlying inflation picked up in September quarter by more than was forecast. And this is data that they're going to be looking at heavily. So this inflation data is a very important one to be looking at. I would hate to be federal government right now because they are in a world of pain if rates go up, which is supposed to signal a stronger economy, right? Because people are spending, people have more disposable income, and that's why inflation happens, because the price of goods become more demanded, and that's what causes inflation. But if you're in government, I'd be very concerned about this, because the wealth effect, I think, there's a very different wealth effect between the middle class, and I think that's a massive problem. So I think items like fuel, which have come down, we haven't even really seen an increase in fuel. If we start to see an uptick in fuel on a global scale, then that's going to exacerbate the inflation numbers, and that's going to mean interest rates will go up shortly.
What governments do, or what the government does, is one of the other things that I'm looking at. It's probably the second thing that I'm looking at. It's probably the most important thing, right? Because we do have, and I'm not going to just single out those in power at the moment, because the other side would probably be doing the same thing, right? Yep. But it's all short-term solutions and short-term thinking that sort of paper over the cracks.
What do they say? right wing, left wing, still the same bird, right?
They're all stealing from the poor to give back to the poor. They're not Robin Hooding it, right? They are because they're going, okay, let's give you some electricity rebates so you pay $300 less this quarter. But where does that money come from? It's our tax money.
Correct.
So it's just, they're instead of, I think government...
Sometimes doing nothing is actually doing a lot.
Doing nothing, letting it happen organically, we need a little bit of pain, right? So if electricity prices go up, then we're paying a bit more, then competitors come into the electricity market and they try and fight each other and bring prices down. Let it happen naturally instead of giving, so that we all think, oh, great, we're paying less electricity. It doesn't work. Let it happen organically. Let the market be the market. Stop trying to come in with a short-term solution to win votes at the next election. The 5% first-home buyer scheme is another one of these.
It's a good example, and I think a lot of people felt that they were rushing in, and they may have missed the boat. But I think this one is definitely, with the 5% deposit scheme, it could be a scenario of only fools rush in this one, where I think if you're going in early and then you are now seeing the interest rates and thinking, oh shit, I shouldn't have purchased because I can see what happened here. Obviously, making the decision to buy or not based off very short-term factors is a massive no-no in property regardless. But I think if you're making a decision with a 5% deposit, where I think the risk comes in if interest rates don't continue to go down, if people were, and this happens, right? If people were buying property with a 5% deposit on the hopes that interest rates would come down, and if they don't, all of a sudden you're at a 95% loan to value ratio, so LVR, property prices may stay flat for a period of time, or if not go up at all. And that could mean that you could potentially be in negative equity if prices do come down at a period in time. And this is where I think the 5% deposit scheme had its risks, because that is where it creates the risk, where if interest rates don't go down any further, or worse, they go up. And there is people that have rushed into the 5% deposit scheme, i.e. again, a lower amount in upfront, so lower equity. It could mean that you're trapped in some of these properties. So I think there's a lot to watch in some of this data, and I'll be following the inflation data pretty heavily to see what happens next and what the RBA decision is.
There's one more big one I want to ask you about, because everyone's talking about inflation, this, inflation, that, but the jobs data is important too, because what that's at a high of recent times. So I think it's a 4.5% unemployment rate, right? Which is high compared to what we've had in the last couple of years. Now, if that continues to move up, then surely that is a case for keeping rates low.
Potentially.
Yeah.
There is a dual mandate for both inflation data, or inflation and unemployment. I think that they would be focusing more on the inflation side of the equation as opposed to the employment data. But employment is still seen as tight. If I look at one of the comments here, so the underemployment rate, the above average share of firms experiencing difficulty finding workers, an elevated ratio of vacancies to unemployed workers, and still high growth in the unit labour costs all support the assessment that unemployment or employment remains tight, and the labour market remains tight. The mandate is to have full employment as much as possible. But I also think with unemployment, I think being unemployed today is very different to being unemployed 30 years ago, particularly with technology. So, I mean, very simply, if you're unemployed 30 years ago versus today, you could, if you have a car, you can simply download Uber and start driving to earn some income. So I think it's very different with technology now. It's different to be able to earn some income. But I think the unemployment component and that argument there is different. The
definition of employment is different.
Correct.
It used to probably be
full-time employment.
But
there's
full-time,
participation
part-time,
rates,
and then there's all these different things.
Yes.
Correct. I still, and again, data is the data, but again, man on the street, I'm seeing a lot of job ads on LinkedIn. I'm seeing a lot out there. I'm hearing people that, big companies that are laying people off. We go back to, like, if this is a tough retail Christmas, do we see businesses close and people lose their jobs? And so there is a chance there that, people might be in trouble. But I think it's unfortunately something that we just need to let happen and get through to the next stage. We can't always, we're very lucky in Australia that things have been good for a very long time. And we feel like it just needs to keep being good and better and better and better. But sometimes there needs to be some dips in the roller coaster.
I think a real conundrum that the RBA could be faced is if there's rising inflation, so above that 2 to 3% band, which already is headline inflation at 3.2, according to the statement. If we start to continue to see it above that 2 to 3% band, then rate cuts will be a thing of the past, and we'll be talking about rate increases to bring inflation down. But then if we start to see a rise in the unemployment rate and a rise in the inflation rate, well, then that's going to be very interesting. I'd love to be a fly on the wall in some of those RBA board meetings, to be honest, because that will be a very difficult discussion to be
try and
having.
get some microphones in there. So, quick prediction next year. What happens, Feb? What happens towards the end of the year?
I want to see the inflation data. If we see that the inflation data remains above that 3% and there is continued pressure on inflation, upward pressure on inflation, the logical analysis is that there's going to be rate increases to try and get that under control. Where does that sit? So where does inflation need to be? Is it 3? Is it 3.2? Is it 3.5? Does it need to be showing to be rising? Or the trajectory of inflation? That's another question. But I think if we do start to see inflation continue on its current trajectory, then we shouldn't be talking about rate cuts anymore.
Yep. My prediction is sentiment is going to be low. People are going to stop spending. Inflation will start to taper again. Some jobs will be lost. And then government will come and incentivize, and that's going to be the trick. If government incentivizes too much, it will be very interesting to see what happens. It'll keep going up. So
vicious circle.
But my prediction based on all of that will be, I reckon I'll say now, and based on right now, I might change my mind in a month or two, but based on right now, I reckon it'll be 3.6 flat
for the whole year.
For the whole year.
Interesting. There we go.
That's it. Let's talk next time.
Great.